Hello and welcome to the weekly commodity market update. I'm Brownfield anchor reporter Brent Barnett, joined this week by Ben Brown with the University of Missouri. Hi, Ben. How are you doing today?
I'm doing great. It's nice to see you and certainly look forward to this. First time you and I have done this combination of host and speaker. So great opportunity to do this, and we wish Will the good health, getting better. So
Yes, definitely. Filling in for Will Robinson today, as Ben mentioned, and we have a lot of really important information to get to. We just had the August WASDE report come out here recently, Ben. But first, before we really get into that conversation, wanted to take a few minutes here to take a look at some of the adjustments for the week in the commodity market. So here's a quick rundown of those prices. September 23 corn was down 9 cents on the week at 473. December 23 corn down 10 cents at 485. September 23 soybeans down 14 at 1334. November soybeans up 18 cents at 1320. Soybean oil for September up 150 at 65.58. Soybean meal for September was down 610 per short ton at 413.10. For the wheat crop, September 23 wheat down 49 cents at 608. July 2024 wheat down 54 at 682. And then we had September crude oil down 74 cents per barrel at 80.86. So, Ben, there's kind of a quick summary of the numbers on some changes on the week. We saw kind of a mixed bag of sorts. What were some of your initial thoughts?
Well, I think for me, the big numbers there, that spreading between old crop and new crop soybeans, down on the new old crop soybean number, up on the new crop. To me, that really signals a little bit of where we're at on the supply side. To take 4 million acres out of soybean production earlier this summer, follow that up maybe with some, a little bit of yield concerns through the end of July. Now that we're into August, I look for that soybean yield number to trend higher here as we move through August. That's going to put some downward pressure on those new crop soybean prices as we look ahead to the next couple of months.
Well, like we said, the August WASDE report has come and gone. That's kind of at the forefront and on top of farmers' minds here. Give us kind of a summary here, Ben, of what we saw come out in the report, and then we can kind of transition and talk about some market reaction to the report. But first, what did we see get released from USDA here?
Sure. So a pretty much a standard expectations report. What do I mean by standard expectations? Well, there wasn't anything that was surprising outside of maybe cotton. Cotton production and that complex was probably the big surprise. Also, spring wheat acres, I think, is another area where we saw a pretty big market move to the bullish side, or excuse me, the bearish side. I think part of that was, I think, the initial estimates that USDA put out back in May were high. And I think people just kind of got that built in and we're kind of using that as their starting reference point. But outside of those, like, we saw a pretty, everything was in expectation. So a pretty neutral report, I think, from a market standpoint. However, I do think there are some things as we look ahead, especially on new crop demand for both corn and soybeans, that give me concern. And all in all, I think we're probably seeing USDA start to bank in that we're going to have enough supply, even with the supply concerns we've seen in several parts of the country. We're going to have enough supply that we're not going to only increase ending stocks for this year, but we're really going to drive down prices, especially in that corn market. And feed grains in general. I shouldn't just say corn. Feed grains of grain, sorghum, corn, and wheat.
What do you think the main takeaways should be here for the producers?
Well, so we've seen some opportunities to price, new crop products. That weather rally in July, I really feel like was a great window for us to market some product, and many producers did. And I hope that we can continue to see people take advantage of that, right? To look back and say, yes, I marketed some product. My concern is that we didn't, right? And so now we've maybe got some concern on 2023 production that's going to have a price well below cost of production. We're going to put a squeeze on producers per acre. Now, the positive side is we've got some strong working capital and some good, strong farm finance fundamentals that I think are going to get us through this year. But certainly, as we start to think about 2024 planted acreage, which I know is a long ways away from now, but as we start to think about 2024 planted acreage, we're going to have a real tight budget on figuring out which acres. And I give the edge to soybeans. I think soybeans has the better supply and demand fundamentals relative to corn. And next spring, we could be talking about soybeans regaining that lead in the U.S. acreage battle.
I know you've talked about ending stocks already here some, but what about globally? What's the global outlook on that front?
Yeah, so I would say we're tight here in the U.S., right, in terms of stocks, especially on the soybean side. We've got a very tight stocks picture for soybeans, but globally, the balance sheet is healthy. And there's product out there. Brazil produced a major corn crop this year. The expectation is a very strong soybean crop here as we think about their planting season just about getting ready to start here in the next month or so. So a very strong soybean crop. There's supplies globally, even though our U.S. market is rather tight.
Yeah, I was going to ask you, Ben, maybe how this August WASDE report data compares to some of the information we've seen recently out of Knab, what we've seen in South America.
Yeah, so I get asked this question a lot in terms of, is Knab a better source than USDA? And my response is that Knab's younger. They're younger than USDA, and so they're still kind of learning some of their methodology. They're developing. They're also, Brazil's a rapidly growing area, so you're moving into areas that don't have the same production. And so when you start talking about a national average production yield per hectare, you're going to get quite a bit of variability. And so there is some challenges, I think, with a relatively new agency moving into some new areas. And so what we've seen is we've now started to see, South America reporting agencies, whether that be Argentina or Brazil, actually start moving closer to USDA's forecast. Here the last couple of months, they've been raising those production estimates, and I certainly think that by the time this is done, we're going to end up with a very large corn crop out of Brazil, a record large corn crop out of Brazil, that frankly has just continued to get bigger and move closer to USDA's estimates.
All in all, Ben, it sounds like maybe there weren't big expectations for the August WASDE, and there weren't too many surprises that came out, right?
Well, so yes, that is correct, and I'm thinking through, you got to think about expectations, and then you think about what you got and whether that was a surprise. I would say that for August, it is a big report. It's a big report day for August, or for in terms of USDA reports. But the big thing this year was that the production is there, right? It's there. In fact, there's actually maybe some upside potential for yields moving higher, especially on that soybean complex. And so now we're switching that mindset away from supply and back to demand, and that demand picture is just not good.
Any final thoughts on supply and demand here before we move on, Ben?
No, I don't think so. I think we're at a period of time where we're starting to look back towards that period of what I call the dog days from 2014 to 2019, where we're seeing stocks used for corn above 15% again. Prices aren't going to retreat as far because we've certainly raised that cost structure, and we're going to move some acres from corn to soybeans to help keep that corn price a little bit higher than what we had during that period of time. But certainly expecting below production costs next year. At least where we currently sit right now.
While we have you with us here this week, definitely wanted to talk about the export front. And we see here on some data that through the first half of 2023, the U.S. ag trade deficit is growing. Is that right?
That is correct. And so we've always benefited, historically, the ag industry, I think, has really celebrated that while there was a national trade deficit for all products, agriculture had a positive story to tell, meaning we exported more products away from the United States than what we imported. That has changed, and we've seen 4 years out of 5 now where we've had a negative ag export deficit more imports coming in than what we exported in terms of value. There's a couple of reasons for that. One, we're using certain products more here in the United States than what we have available to export, and so that's shrinking the physical quantity relative to expectations. The second part that I would mention is that we import some very high valued products. And given where consumer consumption has gone here in the United States post-COVID, to where we continue to buy and we had money right? Like it was, some of that was government payment, some of that was pent up savings, right? We bought a lot of high valued products that we largely, rely on import wise. And so that's kind of what led that gap, that deficit. Looking forward, it's hard to see that picture turning. Soybean oil, for instance, being one. We're not going to export as much soybean oil as what we have in the past, because we're going to use more of it domestically. And when you do that, you shrink the products we're shipping, and that creates a bigger deficit. So part of this is not a negative story from the fact that we're using more of that locally. I think where the bigger issue lies is we're becoming more dependent on international markets for some of these products, some of these higher valued products. And certainly that's where now you start to say, okay, we used to be an export dominant ag economy. We still are by far. Like, I don't want that to get confused, but we also depend on a lot of these markets to supply us with some of the things that we've become used to and depend on. Frankly, we can't live without. It sounds like a third world, a developed nation problem, but yeah, there's things that we can't live without hardly anymore.
I've noticed here recently on the Daily Wire, we've seen some sales pick up to unknown destinations. Ben, does that typically mean those are going to China, or what's that look like?
I think in this case it is, and certainly China, I think, is part of that. I would also say that the Philippines are playing in some international unknown, or some international markets, maybe wheat specifically, to where their sales are showing up as unknown destinations for the time being. I look for those to shift to different product, to different countries as we move through. So yes, some of this is China coming into the market. Why is this happening? Well, our prices are finally now starting to be competitive with other countries. Corn, I'll use the example. Our corn price is now about the same as what you can get out of Brazil. And now we're starting to see some of these flash sales. On the soybean side, we're now competitive again, and we're seeing some flash sales. So some of this is price. As an economist, I feel like I have to say that price is our love language. But in this case, it really is. We're seeing some of these flash sales. What unknown destinations mean is not that a country's trying to hide. It's just a company that operates in multiple countries are saying, we don't know yet where we're going to send that product. It could be to China, but it also could be to one of our customers in Japan, right? Or something like that. And so it's not that they're trying to hide. It's just they don't currently yet know where those beans are going. They just want to make sure they get them on the books.
Ben, like you said, we just came off an important supply and demand report from USDA. What's coming up here? Anything that producers need to keep an eye on in the weeks to come?
So one thing that is of note, only nerds like me follow this, but I certainly think this is a point that is going to draw attention, especially in a state like Missouri, where we had a really rough year and we needed forages, and we chopped a lot of corn that was going to be terrible grain-filled corn, and we chopped it for silage. USDA is going to go back and reincorporate the FSA registered acres in September. Okay, now this is important because they are only going to, the way USDA calculates this is it only impacts the planted acres. And so if there's a change in terms of what was registered to the Farm Service Agency on the planted acreage side, they'll revisit that. The harvested acreage, or the difference between the planted and harvested, or what got chopped for silage or failed, right? That's the difference between planted and harvested. That's not going to show up until January. So I sit here and say, I think we had a few more a few more silage chopped acres and abandoned acres of corn in Missouri than what you're going to see in September, but it's going to take till January before we start seeing those numbers come out.
Ben, really appreciate the update here again this week. And, hopefully Will gets better soon, and you'll be joining him this time next week on the program.
Well, thank you. Thank you very much for doing this. It was wonderful. Really appreciate you stepping in.
Yeah, and again, thanks for your time here on the show, as always. For viewers and listeners, if you'd like to know more about this program or the weekly livestock market update hosted by Megan Grebner, you can visit brownfieldagnews.com.
All right.
He's University of Missouri's Ben Brown, and I'm Brent Barnett with Brownfield. Have a great week.